What I want to know is when I see a stock that is down 56%, okay, I don't say, you know what, time to buy. I say, what went wrong? Why do you have any loans on your balance sheet? I thought you were a platform that every bank I know loved. I was shocked to see how many loans you had on your balance sheet. Shocked. And it said to me that I did not know Upstart. I thought I did, but there are other investors that you and I both know who thought we did, and we were shocked at the amount of bad loans on your, or potentially bad loans on your balance sheet. Shocked.
Yeah, first of all, just to make it really clear, in the first quarter, a single-digit percentage of the loans that were originated on our platform came to our balance sheet. That hasn't changed in our history. We've said we use putting loans on our balance sheet to test new products and new models, and that's largely what those represented. So it's not a change in our model. More than 90% of our loans are originated and held by banks or originated by banks and sold forward to institutional markets. That hasn't changed, Jim.
But 10% of the size of your doing has changed. And then you're moving into auto refi, which I find is the most difficult single business that involved right now, particularly when I'm watching Carvana. And I just say, Dave, come on, man, just go be back to what you were doing. And don't do the price discovery. Just be this fantastic platform that every bank needs in order to be able to access the smaller investors who are really why I liked your company so much. And, you know, when I see vintages that are bad, I think about companies in 2007, 2008 that told me vintages went bad. And you know what? Sometimes I'm still criticized because I didn't say they're all going bankrupt. And I know you're not, but I've got to tell you, it was certainly ill-advised to have that many loans on your balance sheet. And a lot of the bankers tell me it's because you couldn't get rid of them. There was no way you could get rid of them.
Jim, through most of COVID, loans that were targeted a return of 7% were returning more like 12%. A few vintages that were targeting 7% in the latter part, as stimulus went away, will probably return about 5%. So in the grand scheme of our platform, we're pretty happy with that. Banks and investors have made incredible profits, have been incredibly successful on our platform. It's not perfect, but it has performed exceedingly well, and we're proud of it.
Okay, well then, all right, I'm going to ask it straight out. A stock that's down 56% is not a misunderstood stock. It's a stock where people thought there was far more risk than we realized. Correct?
Well, yeah, look, I mean, all else being equal, I'd prefer our stock was going up, but the fundamentals of our business have not changed. Profits and growth have been the combination since we went public in December 2020 and since before that. So again, we're proud of what we're building. We think if the market doesn't appreciate it today, it's okay. We're all right to be understood, because applying artificial intelligence to the business of lending is a fundamentally important change. It's good for consumers. It's good for banks.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Kramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.